Have you been looking for opportunities to expand your dividend portfolio, but feel lost among so many companies? Do you find it impossible to keep up with the fast-paced world of investing, or are you a complete beginner? Then stay with me until the end of this video, because today I've brought you a very interesting company. Hi everyone! In this video, we're going to take a closer look at a company called Alexandria Real Estate. Alexandria Real Estate, founded in 1994, is a real estate investment trust focused on owning, developing, and operating life science and technology campuses in key innovation hubs across the United States. The company's properties are located in major markets such as Boston, San Francisco, San Diego, Seattle, and Research Triangle, catering to biotech, pharmaceutical, medical research, and technology companies. Alexandria generates revenue primarily through long-term leases with high-quality tenants, including Fortune 500 companies, academic institutions, and government agencies. The company currently pays $5.28 per year in dividends distributed quarterly. The next payment is scheduled for April 15th, and anyone who becomes a shareholder by March 27th will be eligible to receive it. The starting dividend yield is 5.46%, which is significantly above the 5-year average. The price per AFO ratio is also well below the 5-year average, and the stock price is trading near its 52-week lows. Over the past year, the company has significantly underperformed the S&P 500. Based on these factors, the stock appears to be heavily undervalued. The most recent dividend increase was 5%, in line with the 5-year average of 5%. Over the past 20 years, the average growth rate was 4%, primarily due to a dividend cut during the 2008 financial crisis. Since then, the company has consistently paid and increased its dividend for 14 consecutive years. The payout ratio appears stable, and since 2021, there has been a slight downward trend, which is a positive sign. FFO and free cash flow per share show a modest upward trend, though the high interest rate environment in recent years has had an impact on performance. The company continuously issues new shares, which is completely normal for REITs, as it allows them to finance rapid growth. As long as the total sales graph follows a similar trend, there is no cause for concern. Debt levels are currently at healthy levels, but the company should focus more on this area in the coming years. However, a slight downward trend in debt has been noticeable in recent years, which is reassuring. Based on the current stock price, the starting dividend yield is 5.46%, which has been growing at a solid pace for 14 consecutive years. The credit rating is BBB+, which is considered strong, especially in this interest rate environment. Based on these factors, the company appears to be significantly undervalued. Disclaimer: this video does not constitute investment advice. Do not make decisions based solely on the content of this video. Always do your own research to determine whether a company aligns with your investment strategy and portfolio. The 2024 annual report is overall positive, as the company demonstrated strong financial performance, achieved stable revenue growth, and successfully managed market challenges. The following key factors support this assessment. Positive factors: revenue growth. Annual revenue of $3.12 billion, an 8% increase compared to the previous year. Improved profitability. Net income rose to $510.7 million, a significant increase from $281 million in 2023. High occupancy and strong rental income, 94.6% occupancy rate, and a 16.9% lease renewal increase, ensuring stable income. Strong capital structure, $5.7 billion in liquidity, providing financial stability. Expansion of real estate portfolio, $1.51 billion invested in developments and acquisitions, indicating long-term growth potential. Negative factors: slight decline in operating cash flow, $1.5 billion, a minor decrease from $1.63 billion in 2023. Long-term debt management. Although the company manages debt well, the total debt-EBITDA ratio of 5.2x may limit future growth. Rising development costs. Inflation and increasing construction expenses in the real estate market could present long-term challenges. With strong revenue growth, high occupancy rates, and solid liquidity, the report is mostly positive. However, the company should closely monitor cash flow trends and debt management. AR is performing well in the current market environment and follows a sustainable long-term growth strategy. Project 2025 is a conservative political plan developed by the Heritage Foundation, along with several right-wing organizations, aimed at transforming the United States federal government under a potential future conservative administration. While Donald Trump previously distanced himself from the project, many of his political proposals and appointments align with the guidelines of Project 2025. Possible short-term impacts on Alexandria real estate equities. Regulatory changes. Deregulatory measures planned under Project 2025, especially in the real estate and construction sectors, could reduce ARE's operating costs and accelerate its development projects in the short term. Tax policy changes. Potential tax cuts or more favorable tax laws affecting real estate investment trusts could enhance ARE's profitability and make the company more attractive to investors. Possible long-term impacts. Economic growth and the real estate market. If the economic stimulus measures proposed by Project 2025 are successful, the overall economic growth and increased demand for office and research facilities could positively impact the value and occupancy rates of ARE's portfolio. Environmental regulations. Potential loosening of environmental regulations could lower ARE's sustainability investment costs, but over the long term, there may be reputational risks if tenants and investors continue to prioritize eco-friendly properties. The political guidelines of Project 2025 could have a favorable impact on Alexandria Real Estate Equities, Inc. in the short term, particularly through improvements in the regulatory and tax environment. However, over the long term, changes in economic growth and environmental regulations may present both challenges and opportunities. It is important for ARE to closely monitor political developments and proactively adapt to changing circumstances. Alexandria Real Estate Equities has announced the issuance of a $550 million bond offering with a 5.50% interest rate, maturing in 2035. The bonds are being managed by several major financial institutions, and the sale is expected to close on February 13, 2025. The proceeds will primarily be used to repay the 3.45% bonds maturing in April 2025, as well as to pay down other debts, fund developments, and for general corporate purposes. Thank you for joining us today on the Financial Freedom Channel. If you enjoyed the video, don't forget to like it and subscribe so you can stay up to date with the latest financial tips and analyses. If you have any questions or would like to share something, feel free to leave a comment. Remember, we're building financial freedom together. Stay with us, and we'll see you in the next video.